Good evening, everyone. Hope all of you are safe and healthy. I think I have more than 1,000 of you have joined me today. Thanks to all of you who have joined Business Line's panel discussion today. Warren Buffett doesn't like gold. Most of you value investors out there would know that he doesn't like investments in gold. He actually once said that gold is a metal which is dug out of lands in Africa or somewhere else. It's melted, and then we again dig a hole, bury it, and pay people to safekeep it. But know what? In the last quarter, the investment company of Warren Buffett invested in shares of a gold miner, a gold mining company called Barrick Gold. He didn't buy a few hundred of shares, but he bought 21 million shares. So this is something which made value investors across the globe turn their head and look at gold and see if they should have that metal in their portfolio. So you, me, everyone, almost all retail investors out there are wanting to have this metal in their portfolio and not ignore it. So this is the reason we are here today to discuss on the potential of this metal, the risks and opportunities the metal presents to its investors. And before we go further, discussing deep into what are the various factors that one needs to look at when deciding on gold as an investment, I think we can have a small poll question for the audience. You'll see that question pop up in your window right now. So at current prices, do you think you should invest in gold? Will you invest or will you not? Yes or no? It will be very interesting to have your views on this question. So think for a second or two and answer this so that we can take it up later as the discussions go on. Right? Yes. So let me now take the pleasure of welcoming the speakers for today's session. I have with me Mr. Somasundaram PR, Managing Director, World Gold Council. Mr. Som is responsible for leading the World Gold Council's activities across the Indian world. Happy to have you, sir. I also have with me today Vikram Dhawan, Head, Commodities and Fund Manager, Nippon India Mutual Funds. He has over 20 years of experience in global commodities markets. I take immense pleasure in welcoming you, sir. It also gives me pleasure to welcome Chirag Sheth, Principal Consultant, South Asia for Metals Focus, the world's top independent precious metals consultancy. Chirag has over 15 years of experience in precious metals trading and research. Welcome you, Mr. Chirag. So let's straight away move into the discussion so that we don't waste any further time into it, because a lot of audience have also have questions with them. So maybe a 40 minutes or 45 minutes of discussion, and then maybe we can take questions from the audience. So Mr. Chirag, my first question to you. So even as the demand for the yellow metal has been dropping, since the time of February that we have seen because of the pandemic, we have seen the gold metal prices increase. So there is always a question that my readers ask me that why is this disconnect between the demand and gold prices? Why is demand dropping at the same time prices increasing? So is there an explanation that you want to offer for this, Chirag?
Yeah, Rajalakshmi, yes. And this is one question that I often, is asked, what's happening? But before I move on to your answer, you mentioned Robert Triffin's very famous quote that gold is an absurd waste of human resource. We dig deep down holes and then we put it in our homes. But I would also like to point out JP Morgan's quote. He said, gold is money, rest everything is credit. So that's the beauty of gold. You find people across the aisle, fascinated with this yellow metal. Having said that, I think, this is one thing which has confused a lot of people. Demand is not there. If you look at last 2 quarters, we've seen negative physical market demand, especially the jewelry demand. And still gold prices have risen by more than 40–50%. I think, what is important to understand is that, and I say this to everybody, gold is like a chameleon. It will change its color with the change in times. Gold is a commodity, gold is a currency, and gold is an insurance. It is important to not confuse gold with other commodities. Other commodities purely behave as commodities, whereas gold has got multiple characteristics. So if you look at gold prices between probably 2012 to 2018, it purely behaved as a commodity where demand and supply played an important role, where the supply outstripped demand and you saw prices falling. When there was economic growth, you saw prices falling. Right now, what is happening is that gold is purely behaving like a currency or as an insurance. And we've got multiple examples. You look at the LTCM crisis way back in the 80s, or you look at the Southeast Asian crisis, or even you look at the global financial crisis. In all these times, gold has behaved as a currency or as a commodity. During these times, it doesn't matter how the demand and supply dynamics are. It's more of the consumer, it's more of the sentiment of the investors, it's more how the currency markets are behaving, and it's more of a safe haven asset. And that is why at this moment, very little impact of demand or supply is actually seen on the gold market, rather than it's more about macroeconomics, more about US dollars, and more about, I would say, safe haven or risk on or risk off sentiment.
Okay, okay. That's great, sir. That's great. But one thing again and again, which people keep raising on gold is that when we look at other metals, say, for instance, copper or aluminum, we usually look at the supply demand factors that drive the metal prices. We know we track the mine supply, we also track the industrial demand, and then we say whether the prices are going to go up or down. But the same thing doesn't seem to work for gold. Why is there a difference between gold and the other metals?
No, so it obviously does work for gold, but as I said, it works for gold when everything is good. It works for gold probably when the economy is doing well and when the other risk assets are doing well. These factors do not play an important role when probably you are looking at a scenario where economic sentiment, or there are macroeconomic issues, or there are geopolitical issues. So as I said, 2013 to 2018, it purely behaved as a commodity where demand and supply played an important role, where mine supply kept on growing year after year. Mine supply put in record growth numbers. At that point in time, you saw that there was a surplus which was getting built into gold, and that's why gold prices was not giving the returns as they gave. Now, what is also important to understand is from an India point of view, we often don't see what is happening in the international market or in the dollar market, because what happens is that India is importing gold. India is buying gold in rupee terms. So you've had a scenario where the dollar prices have gone down, but because rupee has depreciated, in India, we never saw that. So you look at 1980 to 2002, when gold prices just kept on falling, in India, we didn't see that kind of impact because rupee kept on depreciating.
Right. That's true. So that's true. So you're saying that there are different characteristics that gold takes at different point in time.
Absolutely.
As a currency, as a commodity. So how does one get a hint of when this changes, when this characteristic or nature of gold changes?
Yeah, that's a good point. I think as a gold investor, and I've realized one thing, as a gold investor, it is very, very important to also look at what is happening globally, because this is one metal which is very much linked to global geopolitical or global macroeconomic scenario. And you will see that, people who were early backers of gold, or people, in fact, who latched on to gold in this early rally, were the ones who looked at these kind of things. So some very basic things to look at, how the US economy is doing, how the interest rates are doing globally, how is the currency market behaving. And today with the advent of internet, with the advent of technology, all these things are just at our fingertips. So basic understanding of these would help us understand how the gold market actually behaves.
Right. Thank you, sir. So, Mr. Somasundaram, would you like to give your perspective on this? Because you would have seen the consumer behavior, the investor behavior across the country. So, what nature of gold makes it essential as a item in the portfolio, as a tool in the portfolio of every investor?
Well, as you said, Chirag covered it very well. Gold performs differently under different circumstances. And it is an insurance. In the longer term, it is an insurance. So while the questions are about, at what stage do I actually treat gold as one or the other? Well, if you really look at it, gold valuation has different, is impacted by different things. Economic expansion improves gold. We have seen that. Risk and uncertainty going up that has a positive impact on gold. Opportunity cost. If other asset classes for various reasons are not doing well, immediately gold performs well. If they do very well, then gold is not seen that. And the fourth one is sheer momentum, liquidity.
Right.
If you see, gold has all these four, drivers in a sense. Some are strategic, some are tactical.
Right.
And
right.
at any stage in the market, you will see one of this. There's economic expansion or contraction, risks, and then opportunity cost, and then, as I said, the momentum. So you will always have to look at gold in the longer term as a portfolio diversifier. If you really look at how central banks deal with gold, and that will tell us, despite removal of gold standard, why do central banks continue to buy gold? 2018 and 19, they bought maximum amount of gold, not seen since withdrawal of gold standard. Now, why do they do that? So if you really see that, it is more about diversification, and that is where gold scores about than anything else. And the other thing, as a consumer, when you look at a consumer market like India, where gold scores is, once you have bought gold, that is, and particularly physical gold, that's a very interesting phenomenon. You never wake up in the early morning every day and say, what is my mark to market? Somewhere psychologically, I don't look at my gold and say, what's the value of the gold jewelry that I bought during my wedding? I don't. But my mutual fund, every day I get an SMS. One broker or the other says that your valuation has come down, it has gone up, and it just disturbs me a lot. Gold doesn't disturb at all. That's why.
Right, sir. Right. Agreed. So, but tell me, sir, you would have looked at consumer behavior across the country. So, in the past also, when we have seen such rally in gold prices, sharp rally in gold prices, how have Indian consumers reacted to it, sir? How long is the demand absent in the market, and how much time does it take to come back?
Yeah, that's again, if you really look at it, let's since July we saw the prices rise. Before I come to a very the short-term reaction to it, let me tell you, we did a econometric analysis about 3 years ago, and we are doing it once again. When we looked at it, 1% increase in income led to a 1% increase in demand long-term. A 1% increase in price, whether it is through duty or whatever, led to a 0.5% decrease in demand. What does that tell us? That the income has a greater influence on gold demand long-term than price. Having said that, in the short term, price becomes a very important thing, because everybody wants to buy a certain amount. They allocate a certain amount of money, and then they want to give maximum gold within that. So they just look at the price rise and say, is this a blip or is it sustainable? That's what has happened when gold rose from 40,000 to 55,000. Now it's somewhere around 53 and all that stuff. Because people said, oh, 43, it should come back to 40. Now, if you ask somebody, it is 50,000 rupees, I think, you will have the same situation as in 2013. People just, rushing to the nearest store and picking gold. So it is a question of getting adjusted to that range. And in the short run, of course, they look for the price, to bargain pricing, as I would say. But long term, price just is not as much as an influence as the incomes.
Okay. Right, sir. But because in India, the demand is usually linked to the wedding season buying and festival buying. So how long does demand get postponed, sir? Does it come back after 3 months, 6 months? What is the pattern that you observe there?
Yeah, we have seen that, when prices go up in the immediate run, there can be a sharp drop, immediate run. There can be a sharp drop because people would like to wait. And particularly if it happens during off season, like right now, when it is, just the second quarter or the first quarter and things like that. Generally, we have found whatever may be the price. This is again a general trend. In the fourth quarter, towards Dhanteras and others, people do tend to come back because it is also to do with the number of wedding days you have, the auspicious occasions and wedding days, etc. People don't postpone wedding buying beyond a certain point. And also, one more important thing is, people don't buy wedding jewelry only before wedding. Of course, there is a certain amount of buying. They just accumulate.
Plan for it. Yes. So how much of the entire demand is from the wedding markets in India?
See, of the some time back we did this exercise, so it can't be. I don't know whether it's the latest figure, but 60% of the jewelry demand,
Okay.
which
Okay.
itself is 80% of the market, comes from weddings.
Okay, all right, sir. Interesting. So let me come back to you, so on more insights around the consumer behavior. But before that, can we have the poll results, please, so that we understand the mindset of our audience and we can, yes. So the poll shows that 40% people say they'll invest in gold at current prices and 60% say no. So that's an interesting, I think that's an interesting point. What, Mr. Devan, what do you have to say on this? So 60% still feel that there is a risk to gold prices. So can you elaborate to us a little bit in detail on what are the factors that can bring down gold prices from here? What factors, if they play through, if at all they happen, so that investors watch out, so when they invest in gold?
Sure. Yeah, first of all, thank you very much for inviting me on this webinar.
Pleasure,
I
sir.
think, you know, I always believe that speculators watch prices and investors watch fundamentals. So we don't know how high or how low the price will go. But as long as the fundamentals are in place, then, you know, you have to remain invested, whether it is gold or equities or bonds or any other asset class. Now, what are the factors which are driving the gold prices? It's very important to understand. I think most of them have already been articulated by Chirag and so. But I think I'll probably take you a bit, tell you a bit of history, which is also very important in this context.
Right.
See, the gold has actually come a full circle in the past 20 years. 20 years back, the thinking of central banks was to dump gold and buy dollars. And the situation became so bad that they had to sign an agreement, called the Washington Agreement, to limit the supply, the sale of gold. Gold at that time went to a low of about $250 per ounce.
Okay.
So considering where it is right now, so you can imagine how low it had gone. But I think what happened was that in 2001, 2008, and now in 2020, what investors and central banks of all stripes have realized that whenever US would go into any sort of a crisis, economic crisis, their central bank will not hesitate to print money, which not only or reduce interest rates to record levels. This not only reduces the earnings on your dollar portfolio, but it also creates a lot of imbalances in the currency, bond, and asset market. You can see what is happening. There's a complete disconnect between the markets and the fundamentals, and this is because of the actions taken by the central banks. So 20 years hence, dollar doesn't look as invincible and as coveted as it was 20 years back. And gold is one of the substitute for, I'm not saying the only substitute, but one of the substitute for gold. But it's still a very nascent trend. It's still not a tectonic shift in the thinking of the central banks. I'm not saying that central banks tomorrow will dump all their dollars and buy gold. Because typically they are one of the most conservative investors or traders, if you may like to call them. But yes, there's definitely if not a massive shift, a slight shift against dollar, and which is a very, very strong tailwind for gold. Also, the other few factors which the investors should keep in mind is that in past 40, 50 years, both the nominal and real interest rates have been in a structural decline.
Exactly.
Now we are living in an era of negative. I mean, we have seen real negative real rates, but now we are living in an era of negative nominal rates also.
Right.
So as the interest rates go close to zero, the opportunity cost of holding gold becomes negative, or it becomes very, very attractive. So that's another tailwind for gold. Also, the mine supply, the mining industry is in a bit of a crisis, not only gold, but all the mining industry, because since the ESG agenda has come in, and which is coincided with the traditional lenders to the mining industries, shrinking their balance sheet significantly. The large multinational banks who are traditional lenders to greenfield and brownfield mining projects, most of them have shrunk their balance sheets. So it's not easy to get loans for funding, and equity comes at a price, especially if it's not listed equity.
Okay.
Last but not the least, what the gold funds and gold ETFs have done is they have taken gold investing into mainstream. So, for instance, today, if you want to buy physical gold of any grammage or any kg or whatever it is, you can do that with a click of a button with an ETF or a gold fund. So this has also created a very, very, sort of, we live in a world of Amazon. People tend to buy things just because it is easy to buy. And I would call it as an Amazon effect, which is also the ETFs are, have had a very strong influence and demand for gold for investors. And also, the what we have also seen, last but not the least, what we have also seen is that the 5 years back, when we used to go and meet investors and talk about gold, they used to ask us, how much money I'll make in 6 months or 3 years. But today, what they're saying is that, I want to invest. I don't want a view of 3 months or 12 months. I want to invest in gold because I've seen it has given me, inflation plus returns in the past 20 years. So I'm not worried about the short-term fluctuations. There has been, a change in mentality of investors, central banks, which is actually building up this rally. Obviously, things may change, Some of these points will fall off. Interest rates may go up again. In the short term, central banks may become net sellers. You could see even the gold ETFs also selling gold. But till the time majority of these factors are in favor, it's best to remain invested. Now, how high the prices can go is anybody's guess.
Right. Taken your point, sir. Well taken. So, Mr. Chirag, now that we are discussing about the risks also, so what is your outlook on gold prices? Can you give us a target that you're looking at in terms of dollars?
Yeah, we remain bullish, as Mr. Vikram pointed out. There are still a lot of factors which are very much in favor of gold, and I think you're looking at a scenario where interest rates are likely to remain low. Fed in its recent commentary has obviously pointed out the fact that they would like to probably have the interest rate lower for a much longer point of time. I think what is really happening is a case of a classic bull run. That we've seen. Prices went up. Now the correction has probably started. We are seeing a bit of consolidation. So our sense is that prices could consolidate for a couple of months' time in this range, probably about $150, $200 kind of range, and then start to move in. A lot of people often ask me that why is this correction has happened, whether one should buy or not. And I would ask whether fundamentals have meaningfully changed in last, probably 10 days on. So, probably not. Also, the fact that even if vaccines comes in, you are looking at a scenario where 7 people have to be vaccinated. So it is going to take a lot of time. Also, the fact of the matter remains is that economy will take at least year and a half to 2 years to come out of woods, completely. So when you look at all these things, we remain fairly constructive on gold. Our sense is that gold prices could move up to $2,200, $2,300. We are not of the view, which is there on the street about $3,000, $5,000. I don't think, we are seeing that kind of scenario, to be very honest. There is obviously a more upside, which is there. But given the fact that after gold prices have run up by 40-50%, the upside remains capped a bit.
Exactly. Okay. But in terms, when we are talking about gold, we also keep referring about the US dollar index. So what's your view on the dollar index per se, sir? Because there are so many things happening globally which can influence dollar price. So what's your view on that?
I think we believe that, probably the dollar could, go into a, I would not say a structural decline, but probably over the next, couple of years, we'll see a bit of softness in the dollar index. And that would obviously mean that, a bit of flight of capital out of dollar, towards other safe haven assets. You've got your gold, which obviously puts out, and now because, what is happening in Japan with Shinzo Abe resigning, we may see that people may also not look to invest into Japanese yen, which is another, kind of safe haven asset. Also, I think one thing which is very, very important, and I think Som pointed out about opportunity cost. I think at this moment, given the fact that you are into a negative real interest rate, and as Vikram pointed out, you are into negative nominal interest rate, the actual competition to gold is very, very minimal, for that matter. So, as a risk-averse investor, who is probably looking at investing, I would actually prefer investing into gold rather than anything else. So I would advise people that don't look at what has happened in the short term over the last, probably 10, 15 days. I think what has happened was bound to happen. It is much more important that corrections do happen in a bull run like this, because you don't want the asset price to run up too much as well, because you want fresh money to come in. So I would say don't look at what has happened over the last 10 or 15 days. Probably we will have volatility, but these are good, kind of opportunity to probably enter the metal again.
Okay, all right, sir. So you said the gold target of 2,200 to 2,300. So this is over 6 months or a year, sir, just to clarify?
About a year. But it can obviously come in 6 months with the way volatility is. But yeah, we are expecting it over the next 12 months at least.
Exactly. So tell me, sir, what is this in terms of rupees, sir? People want to know in Indian prices what this target would mean.
I'm afraid we don't do rupee forecast as a global company. We don't do rupee forecast, but I think what is important is for Indian investors. What is now happening is that rupee has started appreciating over the last 1 week or so. So while gold price did go up from $1,918 a couple of days ago to $1,960 in India, we've not seen that impact because rupee has also started to appreciate. So I think that is something which Indian investor will always have to be mindful about, because we are importing gold and gold is traded in dollars. So at the moment, what is happening is that you are looking at rupee appreciation. Also, the fact that gold is right now trading at a disparity in the Indian market. It is trading actually at a discount to landing cost. So while gold may be valued higher, you may not be able to sell that at a higher price.
Okay. No, I asked you this question, sir, because a lot of people who have postponed weddings because of the pandemic are wanting to jump and buy in gold for their weddings and other family events. So that's the reason I asked you what it is in terms of rupees. So let us come back to this discussion on prices later. So before that, I think what is also important to understand is the mode of investment in gold. Which form is the safest bet on gold? Mr. Dhawan, do you want to take this question and tell our viewers what is the best way? When I say best, I mean in terms of return and in terms of risk. So which is the instrument which offers the lowest risk and the highest in terms of returns when someone is looking to invest in gold?
Every investor should have 3 buckets. One is the consumption bucket for gold, which comprises of jewelry, bars, and coins, the physical gold watch also. Then you have the investment bucket, where you're using gold as a hedge or a diversification, or for absolute returns also. And then is your third bucket, the insurance bucket, which you keep for the rainy day. So as far as the physical bucket is concerned, please don't mix it up with your investment and insurance bucket, because physical gold, while the feel-good value of physical gold is way beyond, you would rather like to see your gold bars in front of you than to see your gold sitting in some, oblivious demat account. So obviously, buy physical gold, buy gold jewelry. The feel-good will be, it cannot be replaced by any other form of gold. But it's a very poor form of investment in the sense that when you're buying physical gold, especially when it is either minted or it is value added, there is a sunk cost involved. And when you want to sell it, then again, there is a big spread. So you could easily, I don't want to put a number, but it could be a healthy double-digit number where you could lose if you are trading in and trading out your gold. So with regards to the investment bucket, the best way to invest into gold is gold funds or sovereign gold bonds. Obviously, if you are an investor which is looking to use gold to diversify the portfolio, then gold funds are better, because you may want to rebalance your portfolio every quarter or every year. Then gold funds are a lot easier because they form the same ecosystem as stocks and bonds. It's a lot easier for you to rebalance your portfolio with regards to that. Sovereign gold bonds are something to be bought for a longer term. If you are somebody who wants to buy and forget for 8 years, then sovereign gold bond is for you. It's a very good product, but it's still a very niche market. It's not populated by any institutions, so there's no much liquidity in the secondary market. Now, talking about the insurance bucket, uh, the in that obviously people like to put their insurance policies, real estate, or other things as part of their rainy day. But I think, God forbid, if something bad were to befall any one of us, then you would take time to claim your insurance policies. You would take time to sell your real estate. But if you are holding a bit of gold in form of
Right.
gold funds or gold ETFs, you can actually redeem them with a click of a button. So these are the three
True.
buckets that you should hold. Obviously, each it's your personal perspective which buckets need to be filled how much.
Okay. Okay.
One more thing which I would like to say very briefly is, if from the investment point of view, you should be very well aware about your investment objective. Are you a tactical
Right.
investor? Are you an investor who's asset class agnostic, only
Right.
worries about absolute returns, or you are somebody who believes in wealth creation through asset allocation? So all these
Exactly.
three will have a different connotation as far as how much gold and in what form should sit in your
Okay.
portfolio.
Okay. So let me ask you one question, sir, because now that we have to start thinking from a investor's point of view. So if you look at it in terms of liquidity, which instrument? Now let's say we are comparing this between sovereign gold bonds, gold ETFs, and gold fund of funds. So an investor who's not sure when he'll need that money back, and he's putting that amount into gold. So which form is the best, you think?
So, one of the reasons why central banks invest into gold is because of safety and security. Gold doesn't have a credit risk. And most importantly, gold is one of the most liquid assets. So if you are
Okay.
investing into gold in any form which compromises its liquidity, then you are actually bringing down the value of gold. So
Right.
whatever options you have in front of you, look at the option which is the most liquid for you. If you're very well connected in the physical market, then maybe gold bars are good for you. But if you're somebody who's a hands-off investor, then maybe gold funds. Or so liquidity is a very, very important. That is the most understated and the most important attribute. Whether it was
Okay.
2001, 2008, or 2020, when all the markets, bond markets and equity markets were hitting freezing or hitting low circuits, gold was the only asset class which you could buy and sell. Yes, it was volatile,
Right.
but you
True.
could buy and sell any amount. So
True.
any investment into gold which compromises its liquidity, it's something that you should be very careful of.
Okay. Okay. So let us discuss a few more things on this investment perspective, sir, because I think a lot of viewers will also want to know about it. So over the last few years, we have got a lot of digital platforms investing into gold. You have got several platforms for people to invest easily on gold. Any of them today. Say, let us not bring up names here. So we have a lot of digital platforms which are provided to investors who are using different apps on their mobile phones or through their trading companies. So what kind of regulation is there in the market for all these different modes of investments, sir? Because as an investor, as an Indian investor who is very concerned about the safety of money, can you tell me where is regulation playing a role in all of these different instruments, sir? Now we discuss liquidity, so let us also discuss the regulation perspective behind this, sir.
See, as far as the sovereign gold bonds are concerned, RBI is a regulator. As far as the gold
Right.
funds are concerned, SEBI is a regulator. I'm
Okay.
not very sure which entity is directly regulating the e-gold. I'm not casting any aspersion on e-gold, but I think you have to remember that whenever the market is developed, the regulator is matured, then most of the disputes are automatically sorted out. It saves a lot of heartburn and time for the investors and for the service providers. So without casting aspersion on any of the platform, I think personally I would say that one of the reasons the gold funds were successful and gold bonds are so successful is because people see the name of Reserve Bank of India and people see SEBI regulated, and they get a lot
Right.
of comfort in it, because there is
Right.
some, these are all, in a way, you can say pseudo sovereign or government of India sort of is
True, sir.
taking care of these things.
Right.
But something
Right.
like this has to happen for e-gold before, it becomes a viable alternative.
Hmm. Mr. Somasundram, do you want to add your perspective here? Because a lot of people want to know on this regulation aspects around gold in India. Because we have a lot of jewelers offering different kind of schemes today. We have broking platforms offering that. We have a lot of net only platforms offering this model. We have the miners themselves offering a platform for consumers to buy. So are these under regulation in any aspect, or are these at all regulated? Is there any safety to it or not? What is your view, sir, on this?
It's a good question. It is actually there are no regulations. Let me put it like that. Apart from ETFs and those are stock market securities. I'm not going into that. If you're looking at, when I go invest some money with a jeweler, and this is a 11-month scheme, there were some indirect controls brought in through the Companies Act, which said you can't borrow more than 12 months. So, and then you can't pay more than 12%. Now, that is not directly on this. It is for every deposit thing. And this was treated as a deposit. Therefore, everybody now runs a 11% scheme. Okay, 11 months.
Okay. Right.
Now, that is called unallocated gold. That is, it's just a promise to pay you gold. There is no real gold. I mean, you are saving with a jeweler, but the jeweler can go bankrupt. And it has happened also. We have seen one in Bangalore. We have seen one in Bombay. So, and it happens frequently. One bad apple is enough to set it up. But still, let's understand, it is a huge way of buying gold for Indian people. People pay. In fact, there are people who pay on a daily basis 50 rupees, 100 rupees, and at the end of probably 2 years or something, they get a gram of gold. So, in fact, that's a good thing about gold. Gold promotes savings. That's very, very important to know. Having said that, it is not regulated. The second question there is, what about all these digital platforms? Everybody's. Now, when you come to the digital platforms, they are offering products which are offered by, as to the best of my knowledge, 2 players. Okay.
Right. Exactly.
And certainly, that is allocated gold. Although it is not regulated, it is allocated, which means the moment you buy, the gold is kept separate. Okay, so if they go bankrupt, at least in one of them, I know that the gold doesn't belong to the service provider. And they have a similar system like the mutual fund, because this is on the lines of the internet investment guidance that we have globally rolled out. That's the only way. Of course, we have now taken it out. We are going to come out with refreshed guidelines. But if you see, a few months ago, there was something called Internet Investment Guidance. We gave the guidance not just to India, to everybody, to say, please take care that you are buying allocated gold, you have reputed people, etc. Because no regulator has actually gone into the retail side of gold. That's a very unfortunate thing. Okay, so they are leaving it to the market to be ahead of the game, and we face all the problems. We ourselves have also, shared this widely, the internet investment guidance, but it is important for people to be careful. Are they investing in a thing where their gold is kept separate? And is it allocated gold? If it is unallocated gold, it's a promise. It's just credit. Okay, so that's a lot more risky. Okay. But it is time that the regulators, one of them, really come out with these schemes. At the moment, they are saying this is just purchase of gold. You're just buying gold. How many schemes can they do it? Having said that, when something is very important for the society, you can't simply put a model which we have got and say it doesn't fit into my model. You got to create a model for our society. Our society buys gold this way. They want to buy gold with small savings. Banks are not allowed to give gold-based financial savings, unlike in China and other places. That should also be brought in. Why should this not be regulated through the banks? So we need to look at this. It is time that regulations come in, and banks are also allowed to run such schemes. Then we must see whether the safer person would like to come to a bank to save in gold.
Exactly. There will be an option in which case for him. So how does this?
So Rajalakshmi,
Yes,
I'll
sir.
just like to a slight disagreement with Som. See, they are nowhere close to mutual fund scheme, because you have to appreciate, in case of mutual funds, we have a dedicated custodian, which is in the Indian ecosystems, only most of the custodians are either foreign banks or Indian banks, and they have a lot more at stake than just a vaulting agent. So I think when you're talking about gold held by mutual fund, there are two layers. There is also the brand, the brand, and there is also the the track record of the mutual fund. But there is also the balance sheet and the brand and the track record of the custodian. So you have a double safety
Okay.
in mutual funds. Not to
Mm-hmm.
mention that the banks are also regulated by SEBI and RBI, and we are regulated by SEBI. So
Right.
there's a lot. There are the leash is there's hardly any length of the leash which is given to us as far as the gold held under mutual fund is concerned.
Okay.
Vikram,
Okay.
can I
Yes,
just
sir.
add here?
Yes,
Sorry,
sir. Please. Yes.
exactly what you say is, at least I know in one of the case, even in the second case they have, there is actually a trustee, there is a custodian, and there is the infrastructure provider, and that is what we consider as safer than these jewelry schemes. But obviously it's not regulated, but it
Regulated.
again banks and independent agencies who do that. So even the settlement is handled separately, not by the company itself. So, but as I said, it can never be equated with the investor. I was just mentioning it to say that the
Okay.
structure is very similar, but it's not obviously regulated.
So
Yes.
we have to
So the
publish
point.
NAVs every day of how much gold we are holding, and so I think unless let them reach that level, then we are at par.
Yeah.
So
True, true. But Mr. Somasundram, one more point that I would like to ask from you is, how does this work in other countries, the other developing countries, the Asian countries, consumption-related buying in gold? So there, who plays the role of a regulator in the consumer market for gold?
Yeah, it's the same thing. Nowhere is it regulated. In fact, you'll be surprised. In many even advanced countries, Germany is slightly different because even post offices and all sell gold there. Actually, because there you could see that. But generally, otherwise, it is not a regulated product anywhere. Okay. In China, of course, they have, since they came in later into the gold industry, you will see ICBC running gold saving schemes where you can go and just open a gold deposit account. So that is regulated by PBOC. But other countries, you will even find that in their website, they will say that, let the buyer beware. And retail schemes are always, very, very, fraud prone, things like that. That is why we as a council now, we are trying to bring a global retail gold investment principle framework and see how this can work amongst all the players.
Mr. Chirag, do you want to add a point here? Yes.
Yeah, I just wanted to come in. So as Som rightly pointed, if you look at places where digital gold is very popular, you've got parts of Europe like UK where digital gold is popular, or even in Asia, you've got Indonesia where, like India, there are a lot of wallet companies where it is picked up. Most of the places, there is no regulator as such. Yes, there are custodians. Like I know for the fact that there is one digital player who's got IDBI as a custodian, right? So there are custodians who are there. I think what one also need to understand is that probably aside from China and Turkey, where gold savings accounts are allowed, nowhere else, the physical gold market as such is regulated. I think, and that's why, as Som rightly pointed out, there have been multiple cases which are there. Having said that, I think it is very, very important to understand that when somebody buys digital gold, after every transaction, a invoice is sent to you where all the details of your GST number and various things are mentioned. So at least there is a certain amount of layer which is obviously, there. Not an unallocated account. I think we need to understand the differentiation between unallocated account, which is also there globally, not so much so in India, but in Europe, there is a lot of unallocated trading which happens. Vis-a-vis allocated account. Allocated account is where it is in mining. So you look at places like Indonesia, Thailand, India, where digital gold is big, there is no player, apart from Turkey and China, where there is digital savings bank account, which is there.
So this looks like a universal problem in the gold market. So I think it's consumers beware everywhere. Okay. So another important aspect when we are talking about gold is the is the taxability of it, when it comes to the taxability of it. So consumers, when they, investors, when they take a decision, they look at liquidity, safety, and also the taxability of gold instruments. So Mr. Dhawan, would you like to talk a little bit, around the taxability of gold ETFs?
So, as per the regulation, the on land of the law, anything which is in the investment ecosystem, anything which is not equity is treated as non-equity, which means implies debt taxation as far as in the investment space is concerned. But yes, you get the indexation benefits and all those things. So
Okay.
that is where it stands. And I think you have to realize one thing, that the mutual fund platform, it caters to long-term investors. So and I mean, obviously we actually discourage tactical investors. So if you're coming to mutual funds to invest into gold, we are assuming you have at least a few years time horizon. So if you have that kind of a time horizon, then tax doesn't become a big issue. But yes, if you are trading in and out, and quite frankly speaking, gold, if you really want to trade gold, I would say there are a lot of other commodities to play around and with gold.
Okay.
And so it actually is not. I mean, we haven't lost any business purely from the point of taxation. Really
Right, right. Okay, okay. Point taken, sir. So another aspect, I think, when we were discussing about the safety aspects of it, for a long time there has been a talk around setting up a gold exchange in India, which helps the consumer buy and sell through the exchange. So at what level is this discussion on, sir? You may know better than all of us. So at what level is this discussion on, sir?
So I think for me, the wish list is different. I have the benefit of working all across North America, and so what I've seen is that one of the reasons why gold, well, I would say that yes, gold may not be regulated, but the major players in gold are extremely regulated. The major players still are banks in gold. One of the reasons why gold is so liquid, because besides whatever volume you see on COMEX, MCX, or NYMEX, or wherever, the physical gold, there's a very deep interbank market where even the central banks are also borrowers and lenders. So I think in India, we have done a great thing in allowing mutual funds into gold and commodities, but the big bang will actually happen when banks are also allowed to go beyond the act. Right now they are just channelizing agents. They are just acting as agents, agencies. So once banks are allowed to, trade in gold, invest in gold, to my mind, there is no reason that why we may give the London Bullion Market Association a run for their money. Because today, where is the liquidity lying? It's lying either with the mutual funds or with the banks. The retail investors or HNI can take out only that much. So if you bring mutual funds and banks into look at the debt market, who are the major players in the debt market? So if you bring out banks and mutual funds into gold, there is no reason why, as Chirag mentioned, that we are price taker, we become price giver, but that to me, that's a bigger reform than the spot exchange.
Right, right.
But to answer your question
Somasundram,
about spot exchange, yes, it's been on the anvil for quite some time. There was, this discussion on again, the regulatory aspects, under which regulation it would come. Because what you have to appreciate is that physical goods are not under the purview of Ministry of Finance. They're also under the purview of other ministries also. So that is something which that loop has to be closed.
Yes. Mr. Somasundram, would you like to give your views on this, on the gold exchange and the developments around it? What is the thinking of the government of India on these lines, sir?
I think Vikram covered it beautifully, in the sense it's not just about one thing. You can't bring an exchange and still say that our bank can't buy and sell. So there are regulatory enablers. The primary regulatory enabler is introduce bullion banking, which is banks must be allowed to take bullion in their balance sheet. Today, they are only channelizing agents. So, but we have done some work. We have collected a steering committee. We even published a blueprint, which is the committee saying how this should work. T+1, settlements, who will do it. Everything was discussed with the industry. And now, since then, the government has also announced an international bullion exchange, where they say in gift they could do it. So I think we believe that these infrastructure changes, just like how China did it, is very important for India. Otherwise, you can't bring gold mainstream. But primarily, I would still leave it with what Vikram said. First thing is allow and free the banks to deal with gold. They are good risk managers. They know if they can handle FX risk. Why do we believe they can't handle, gold risk? I think we should first start getting that, and then the exchange will be a natural, outcome of that.
True, true, true. Very true, sir. So I think this brings us towards the end of this discussion. Thank you so much, gentlemen, for joining me today. We have discussed a variety of things over gold, right from the gold price target to the issues around regulation, to which instrument is the safest bet. A lot of points which were of interesting, takeaways to both consumers and investors in metal. So I think we have a lot of questions from audience. Let us take in one after the, one by one. So I have Mr. Balashiva Shrikant, who's asked a question on why gold prices crashed during the demonetization period, and was the crash purely related to demon? I'm not sure if any of the speakers want to take this question. So any of you want to answer this? Mr. Somasundaram, do you want to take this question now?
I don't know where he got the impression it crashed during that period. On the contrary, it probably touched equivalent of $2,000 during that period. But what he means is subsequently, there was definitely liquidity issues and the market went into deep discount. There was no doubt about it because everybody had to do their accounting bit. So the reason is, again, as I said, because gold has been operated largely by organized way and to a little bit in an unorganized way. Let me leave it like that. And the accounting did becomes a problem when such big transparency measure is taken.
Okay.
I think also I like to add. I like to add to Som's, what Som said is absolutely right. And I think from a longer perspective, if you look at the charts, around that time in 2016, gold was making a long-term bottom. So it also coincided with the bottom. So actually it was a very good time to buy gold, if you really ask me.
Yes, absolutely.
True. So there's another question for Mr. Som. Specifically, he's mentioned Mr. Somasundaram's name in the question. So he's asked, how exactly does uncertainties in the economy improve gold prices? Is there a link, exact link that follows uncertainty in the economy? He's wanting to know.
Well, it is very difficult for any asset class to say if we can measure uncertainty. It is not uncertainty. So that is very important to know. So uncertainty is uncertainty because you can't measure it. The issue is there is nothing. But if people are interested, just a very quick one, there is a tool which we have in one of our websites. You can go to Quorum. It is a gold valuation framework. You can plug in your own figures of GDP growth, dollar, demand, everything, and it will give you the gold value. What is the implied value of gold? So people who are statistically inclined and all that can use that framework. We have developed it after a lot of work. It might be very helpful for people. But again, I'm saying it is not a price forecast. It is a gold value. What should it be valued when an economy has these factors?
Okay. I think the next question is from Mr. Robin Barr. He is asking that now that gold prices have had a significant upside, should one look at investing in silver or platinum? Mr. Chirag, do you want to take that question up? He's asking if silver or platinum is a better bet at the current levels compared to gold.
I think, leaving aside, how much run is left for either gold, silver, platinum, I think it is important to understand that silver is also always gold on steroids. You will always find, silver with higher volatility. So, even in that sense, you will always see silver catching up, either outperforming on the upside or underperforming on the downside. Also, I think one thing which is beauty about silver is silver takes cues from both base metals as well as gold, right? And I think it is important to understand that at what point, what kind of behavior silver has. So at this moment, if you look at, or if you actually take a step back and look at last 3 or 4 years, silver took cues from copper, other base metals. Right now, silver is kind of catching up to gold. Our sense is probably, silver will probably move up to $32, $33. So in that sense, if you look at on the percentage basis, silver will kind of outperform, gold in that sense. With regards to platinum, at this moment, I don't think the fundamentals are probably that strong, in terms of both platinum and palladium, because what you're looking at on the demand side, especially the industrial demand, mind you, 80% of platinum's consumption comes from industrial demand. So you look at auto demand, which is the key, and then followed by pharmaceutical and chemical. All these components of demand are impacted. So while we may see all, I would say, precious metals prices moving up, I would be more comfortable. If I were to choose one, I would be more comfortable in silver, rather than platinum.
Okay, all right, sir. Next question is from Mr. Anand, is for Mr. Dhawan. So he's asking, is there a liquidity problem in gold ETFs in the secondary market in India? How much of a gap is there between the NAV of the fund and the price at which it trades?
No, I think yes, there are various funds, and various funds would have liquidity, and which is the nature of the beast in the mutual fund industry. You can have 50 large cap funds, and each fund will have a different set of liquidity. I mean, we are fortunate enough to be the most liquid gold ETF and gold fund. You can see the turnover at the exchange. On a good day, it can go to anywhere between 50 to 100. But I think the most important thing that you need to appreciate, a couple of things you need to appreciate is that gold ETFs, our gold ETFs, and also the gold ETFs of the other fund houses are 100%, almost 100% backed by physical gold. So they are a proxy for the physical gold prices. If the physical gold market is at a discount to London, it will be reflected in our ETF listed or trading price. Similarly, if the physical demand outpaces the supply, what we saw in March and a bit of April also, when there was a paucity of bars available and the Indian market was at a steep. In that case, the ETF would trade at a premium to the London prices. So this is a function of demand supply, and the reason why we invest, or for that matter, all the funds invest 100% into gold, because gold has got AAA rating. As Som mentioned, it is not a promise to give you gold. It is gold over there. I mean, I wish I could take you to the vaults to have a look at that many bars, but I can't. But it's backed by physical gold. And secondly, there are market makers, and in a commodity like gold, rather a currency like gold, there are, which is so efficient and so attractive to arbitrageurs. Whenever the price deviates a little bit or up or down from the physical price of the Indian market, there is an arbitraging happening over there. So in terms of depth, you can probably do hundreds of crores without actually disrupting the market.
So the difference in the price between the NAV and the market price of the ETF, it doesn't impact the investor as such, sir?
So I think that is where you have to appreciate the beauty of ETFs. So what happens in an ETF is, unlike a fund where you have to go to the fund house to subscribe or redeem, in case of an ETF, whatever is the unit size, suppose it's 1 gram unit size, you can actually sell and buy 1 gram with maybe a spread of 0.25% or 0.5%. But just imagine if you have to sell that 1 gram physical gold, buy 1 gram on Monday and sell that 1 gram on Friday. I would like to know how much spread you paid in doing that in the physical market. So that is the beauty of ETF, that instead of buying 50 crores, 100 crores worth of gold, only then you get the screen price. You can actually buy few grams, and you're actually getting the screen price for it. And that is why, as I mentioned, that ETF coming in has actually empowered the investors.
Right. Agreed, sir. So Mr. Amit Solanki is having a question. I think a lot of questions are similar. So one is, they are asking what will be the impact of the US president election on gold market? And the next question is, what is the outcome of a COVID vaccine being discovered on gold prices? So both these questions, any of you who wants to take it? The US presidential elections. Mr. Somasundram, do you want to answer that? Yeah.
As I said, there will be events. not the last time we are going to hear such important things. There will be ups and downs, immediate short-term reactions. Now, if you're, as Vikram said, if you're a short-term trader to go in and buy or and sell, then all these things matter. Otherwise, you got to see about the larger context. What is the larger context? There is so much of liquidity in the global market. All currencies are getting diluted, and there is a lot of uncertainty about economic, reversal, whether it will be U, V, W kind of, recovery. Now, in this environment, obviously holding gold will make sense. Now, if you are saying that, no, I want to hold it for 2 weeks, now that none of us, I think, in this panel can give an advice to that. But if you say, yeah, I want to hold, instead of 15% gold in my portfolio, 20%, I think we can easily answer that question now.
Right. So, and in terms of the vaccine, sir, in terms of everyone wants to know what if a vaccine is, there's a news of a vaccine discovery from Russia or somewhere else, and how will gold prices react to it?
The vaccine availability, if I may just add it, and my co-panelists can join it, we already know. Market would have already factored it in. It's a matter of time. And if you ask Vikram, he will say that. I mean, once this is in market domain, people have already factored it in. It is coming sooner than later. So on the day it is announced, there will be volatility. As Chirag rightly said, there is going to be volatility when there is an uptrend. And the point is, if you are so worried, just do a SIP kind of stuff, buy small lots in this thing. But will a vaccine completely change the scenario? I mean, I am not very sure that any economist would even say that. Yeah, it's going to make us more confident. It's going to increase consumer demand. But in terms of long-term price impact or even medium-term, I don't think it's an event worth even discussing. It's already there.
I think, Rajlakshmi, if I can add to what Som pointed out, whether coming of a vaccine meaningfully changes my economic scenario, that is something which is very, very important. Even if vaccine comes in, you've got 7 billion people. You look at the number of doses that can be administered or manufactured in one phase, it is going to be a very, very mammoth task. Second, the damage which has been so bad, it could take at least year and a half. So as I pointed out in my opening comment, there will be volatility. There could be $100 fall, which may happen because this is market, and that's the beauty of the market. Everybody's right, everybody's wrong. It's the market who determines who's right and who's wrong at the end of the day. So we'll have that. But vaccine doesn't meaningfully change the fundamental of the economy.
Also, I think I would like to add to what Som and Chirag said. See, it's very sobering to know that I'm sure Som will have the exact figures than me. If you look at the 50-year, 20-year return of gold, we are still talking about either close to double digits or very near or above double-digit returns. You will have to struggle to find many things which can give you that kind of a return. So again, I'm part of mutual fund. I'm programmed to tell people that past performance is no guarantee of future returns. But something which is performed for 50 years, it will take a lot for it to not perform for the next 20 at least.
If I may just add, the gold price between 73 and December 2019. I didn't take the January rise. December 2019 in INR price, gold has gone up by 14.1% CAGR.
That's really a good number that may appear very impressive for investors. So now there's another question, sir, which is popping up. He's asking whether to invest in gold in a lump sum or in an SIP form. Mr. Dhawan, this question is for you. So he's asking whether to, tell me.
So if you see the last peak of gold, which occurred in September 2013, if you would have put all your money, if you were unlucky enough to buy all your gold at that point, you would have still got about 6% returns annualized. But if you would have staggered that for 1 year or 2 years in an SIP, then you would have got a healthy double-digit return. So I guess it answers your question, and that, as what Som also mentioned, that it's better to stagger your returns. Unless you're a tactical investor who's looking for a 3 month, 6 months window, then I think entry and exit are most important thing. But then again, we don't know whether it is an art or a science. Trading is still trying to figure out.
Right, right. That was a very interesting, point to it. So, Mr. Chirag, someone is asking me, is silver the new gold?
Yeah, look, silver has had many names. Silver is poor man's gold, gold sister, brother. Forget all those things. I think what is very, very important is, as all of us have pointed out, precious metals, be it gold, silver, it is important to have these as part of your portfolio. The percentages can keep on changing as per the change in times, as per your risk appetite, as per your investment horizon. But I would say both gold and silver, and even if platinum, if you are able to access platinum, even that should be part of your portfolio. I would say everybody should have precious metals as the part of the portfolio. Yes, obviously, what is going to happen is that one will outperform, another one will underperform based on the characteristics, and that's why that is upon how well you want to. I would say, as an investor, what is it that you are looking at?
Okay.
At this moment, a lot of people come and ask me whether I should buy gold or I should buy silver. I would actually say buy both.
Right.
You could have, probably 60% or 70% gold, 30% silver, but at least have these in your portfolio.
So one Mr. Madhusudan is having a question for you, sir, Mr. Chirag. So he's asking,
Yeah.
why do we always talk of gold in hindsight once it has taken up its rally after crossing, key levels? Why don't we predict or anticipate the rally? We don't get gold anticipation from any of the analysts. So that's his question.
No, I think, see, I'll tell you what, this is actually true about every asset class. We start talking about it once it has obviously run up. But I think that's also characteristics of a professional investor and a retail investor for that matter. While we, as people from market, we also often talk about the efficient market, theory where information is available to everybody. But also as investors, and I've, look, with my small career of 16 years into precious metals market, one thing which I can obviously say is the problem is that people as investors, we also need to put in effort to educate ourselves, to understand about the characteristics of various asset classes. And that's where the problem is, as investors in India, especially,
Right.
having worked with a global bank, I can tell you that investors in India do not want to put in that effort of educating themselves. We call up our brokers, kya lene ka, kya bechne ka, what to buy, what to sell. That's it. So I think it's a fault of all of us as part of the ecosystem in that sense. And I think we always, talking about hindsight is always, easier in that sense.
True, agreed, sir. Taking your point. So now that we have discussed gold, silver, platinum, now there's a question on cryptocurrencies. I think Mr. Dhawan would like to take it. So someone is asking me, Mr. Ashwin Ramakrishnan is asking me if cryptocurrencies can become a replacement to gold in the long run.
So cryptocurrencies as a concept is fascinating because it is not under any regulation.
Okay.
So far I've been talking about regulation since I'm part of that industry, but you always are fascinated by things which are completely unregulated. And in this case, you have to appreciate there is no tax regulation, there is no KYC regulation. But I think what it suffers from is that it is still not backed by. So, for instance, dollar is backed by U.S. Federal Reserve, gold is backed by gold,
Correct.
bullion banks and mines or whatever. So this is still not backed by large institutions. And we have had more than a few hiccups in cryptocurrencies also.
Okay.
So unless it is embraced by a country or a central bank, but then again, it loses its independent its autonomy. So it's a very interesting thing. But I think more than the cryptocurrency, it is the blockchain technology
Okay.
which is of more use in the industry than the cryptocurrency itself. Also, I think what one thing you need to understand is that ultimately when you're buying a stock, it is backed by a share of a company. You're buying a bond, it is backed by debt, whatever. But over here, there is nothing tangible that you're getting. So there are pros and cons. Yes, it is autonomy, but there are pros and cons that you have to measure. But I think at this point of time, it will still remain a very marginal thing. Leave aside gold, it may not even threaten so many other commodities also.
Okay, okay. Mr. Somasundram, do you want to add to this point, sir, on the kind of risk that cryptocurrencies pose to people?
Well, as I said, we generally don't cover crypto because at some stage when it touched, dizzying heights, we did caution people saying, look, gold is backed. You can see a gold, exactly what Vikram made, and you don't see anything here. And you lose your password key, it's gone forever. So there are lots of issues around that. But I'll probably say something in addition to what Vikram said. So you see, why do these asset classes develop? Of course, one is the blockchain technology, etc. This is again because repeatedly people are looking with money to buy something which behaves differently, or which is bought differently, or which is used differently, or where the KYC requirements are different. They are trying. It is an arbitrage. At the end of the day, some arbitrage. Now, that's where it is important. I mean, the lesson I would draw for a country like India is, society wants a certain way of buying gold. I'll go back to my old. We need to design the system, the regulatory oversights to promote that, and not say that, let me wait till the entire society comes up to the level of buying ETFs. Let's put it like that. And I will, otherwise I will not, there is no way we can regulate that. Then what happens is you go into risky saving.
Correct.
Yeah. And
sir.
in the sense, in the international way, this is, you can say it's a risky saving. So this is how these things develop. And I think it is important for industry also to push the case for each industry, I'm saying, and particularly gold, to push the case for the right kind of products for each the country, whether it be gold, whether it be savings account, whether it be ETFs, commissions, because people love gold. Otherwise, what will happen is people with money will look at, why don't I do something in crypto? Anyway, crypto is not permitted in India, all that stuff. So this kind of issues will come up. So our view is crypto is something from where we should draw lessons for gold regulations and how to promote gold savings rather than, just address it as a, and I'm of the same view as with, it's not a big threat anymore.
Right. Point taken, sir. I think very interesting discussion for the last 1 hour, and a lot of viewers have been continuing to engage with us all through the last 1 hour and 15 minutes. I think all of us should come back on the same platform in the next 6 months and discuss the stand on gold again. So thank you, gentlemen. Thank you for joining me. And audience, I think our next on the series for BusinessLine Knowledge series is on the healthcare sector. So do join in for our next webinar too. Thank you so much. Thank you so much, everyone, for joining us. Thank you, sir.
Thank you very much. Thanks, Claire.
Thank you, sir.
Thank you.